Welcome to the weekly market update. I'm the Options Overlord, and this is the market week ending July 17. Read through an options lens. Educate, discipline, execute. Three numbers on your screen. The S&P closed at 7,457. The Qs at 695, and the VIX at 18.77. What those numbers mean for options sellers is the next 8 minutes. Let us get to work. First, the ground rules. Every week, no exceptions. This is educational content only. It is not personalized financial advice, and nothing here is a recommendation or endorsement of any security. Options involve substantial risk of loss. Past results do not guarantee future returns, and options have tax implications, so consult a tax professional. I'm not a licensed financial advisor. Before you act on anything, consult a qualified professional who knows your situation. By watching, you accept these terms. Good. Now let us score last week. Accountability first. Every week, this channel sets a rule for the week ahead, and every week we grade it in public. No exceptions, no quiet deletions. Last week's rule: track VIX 20 as inflation data tests broad participation. Watch level VIX 20. The verdict: broke. The VIX finished at 18.77, below the 20 watch level. But that is only half the rule. Breadth fell to 43.9% of S&P names above their 50-day average, so broad participation did not survive the inflation test. The level held. The participation broke 0 for 1. The record starts honest. Next week we grade the new rule the same way. The scoreboard. The S&P closed at 7,457.69, down 1.55% on the week. The Nasdaq 100 tracker QQQ closed at 695.33, down 4.16%. And tech dragged the whole tape. The VIX finished at 1877, up 3.74 points. The 10-year Treasury yield fell 1 basis point to 4.55%. And breadth, 43.9% of S&P names above their 50-day average. Now the Overlord lens. Coming into the week, the options market priced a 2.45% weekly swing. The S&P moved 1.55%, calmer than the options market expected. And that gap between priced fear and delivered movement is where the disciplined sellers earn. So, the market paid for a storm and got a squall, and sellers who kept their rules collected the difference. The Overlord number of the week. QQQ IV rank at 77.2, the top of its 12-month range. Hold that thought. It is the story of this whole week. And on screen, the S&P against the VIX for the last 3 months. The regime map. 1 picture, 4 boxes. Where are we? This week, participation narrow, index IV low to moderate. Only 43.9% of S&P names sit above their 50-day average. So fewer stocks are carrying the index. And the IV rank split tells you where the market thinks the risk lives. QQQ at 77.2, SPY at 26, IWM at 20.3. The index looks settled while Technology Premium sits near the top of its 12-month range, and that divergence is the rule signal of the week. Translation: fewer stocks are doing the lifting, and the options market has already noticed where the weight sits. That is the regime, narrow at the base, charged at the top. The premium read, where the market is actually charging for risk. QQQIV rank 7.2, the top of its 12-month range. SPY at 26, the lower range, though is percentile of 61, says it still sits above most of the past year's closes. IWM at 20.3, the bottom fifth. The lens, QQQ's rank of 77.2 is the highest of the three by a wide margin. A rank near the top of its 12-month range means the market is charging more for technology risk than it has almost all year, meaning bigger premiums on tech are not a gift, they are the price tag on genuinely higher risk. That is not generosity, and it is not free money. It is the market's price for uncertainty. The income lesson this week: premium is the market pricing risk, not generosity. Read conditions, not tickers. And if you want to pressure test a stock you own against basic covered call criteria, the free Covered Call Qualifier checklist is linked below. What actually mattered this week? The lead: cooler inflation lifted stocks temporarily. The S&P 500 and Nasdaq advanced Tuesday after June CPI came in cooler than expected, and solid bank results improved sentiment. By Thursday, the mood turned. Semiconductor losses outweighed firmer retail sales, lower jobless claims, and positive corporate results. Friday, the chip selling broadened across the market. Renewed US-Iran hostilities lifted oil, and all three major indexes finished lower for the day and the week. Rotation: energy up 3.5%, technology up 2.8%, communication services up 1.3%, industrials down 2.6%, and basic materials down 2.4%, brought up the rear. Rates: the 10-year eased 1 basis point to 4.55%. No help and no harm. The takeaway: Treasury yields eased slightly, but a 15.35% oil surge and semiconductor selling pulled the major indexes lower. Oil up, chips down. Risk watch, and this is the important slide this week. The VIX reads 18.77, low to moderate, but here the discipline line. A calm headline VIX is not low event risk, not with mega cap earnings and the FOMC ahead. Next week, the mega cap earnings wave lands midweek, then the week after brings the heavy calendar. The FOMC meets Tuesday and Wednesday, July 28 and 29, and PCE inflation follows Thursday morning, July 30. Alphabet and Tesla both report Wednesday, July 22nd, Tesla carrying a 7.5% implied move, and Intel follows Thursday, July 23. Those are event risk examples, not candidates. Calm-looking regime, loaded calendar. That combination is exactly when discipline earns its keep. The Overlord Read: narrow breadth and technology premium stays elevated. The divergence: breadth fell to 43.9%, while QQQIV rank reached 77.2 against SPY at 26.0 and IWM at 20.3. Put simply, the index looks calm while the engine room is priced for turbulence. Why it matters: Market participation narrowed while options pricing concentrated the risk in technology. The premium is not spread across the market. It is stacked on the handful of names doing the lifting. When the stock market looks calm and the options market is charging up, listen to the options market. It is the one putting a rule price on being wrong. So here is the rule for next week. Set now, graded next Friday. Watch VIX 20 as narrow breadth meets mega cap earnings. Watch level VIX 20. A break above 20 with breadth below 45 would confirm a changed risk regime. That is the line in the sand, and we will score it in public next week, held or broke with the numbers. If this read helps you trade with more discipline, subscribe. Next Friday we score this rule, rebuild the scoreboard, the regime map, and the Overlord Read. The free Covered Call Qualifier is linked below. Thank you for watching. Stay disciplined. Let us go.